Hello everyone, I'm Văn Kiệt Luân. In today's video, we're going to dive deep into one of the most important topics from William O'Neill's book, How to Make Money in Stocks, and that is market direction. Specifically, we study two core tools that O'Neill uses to read the market: the follow-through day, the signal that confirms the market bottom, and the distribution day, the signal that warns of the market top. This is the part that the vast majority of individual investors ignore, and it's precisely why they keep buying at the wrong time. After this video, you have a clear framework to answer the question, where is the market right now and what should I do? Let's get started. Before we get into the specific techniques, I want you to understand why market direction matters so much. O'Neill studied thousands of stocks over more than 50 years, and it covered one thing: 3 out of 4 stocks, that's 75%, move in the direction of the general market. What that means is, even if you pick the right company, the right product, the right fundamentals, if the market is heading down, your stock will most likely go down with it. O'Neill divides the market into 3 main stages. First, confirm uptrend. This is when you buy aggressively. The market is in an uptrend that has been validated. Second, uptrend under pressure. Be cautious. The market is showing signs of weaknesses. Reduce your position size. Third, market in correction. Get out. No new buys. Move to cash. The O'Neill code I want you to remember: recognizing when the market has stopped or bottom is frequently 50% of the whole complicated investment ballgame. 50%, no stock selection, no fundamentals, market timing. Now, let me introduce the first tool, the distribution day or D-Day. A D-Day occurs when the index falls at least 0.2% on higher volume than the previous day. This is the signal that large institutions are selling, distributing their shares. Why does volume matter? Because institutions hold tens of millions of shares. They can't sell everything in one day. They have to sell gradually. On unusually heavy volume on down days, that's their footprint. How to act based on the D-Day count. 1 to 2 D-Days is normal, keep trading. 3 D-Days, yellow alert, watch more closely. 4 D-Days, danger, reduce exposure. 5 D-Days or more, exit immediately. There is also a variation called the stalling day. The index closes slightly up on very heavy volume, especially with a long upper wick. This is institutions quietly distributing into strength. Our first historical example of D-Day, the Dow Jones in 1990, taken directly from O'Neill's book. Do you see the number circles on the chart? Each circle marks a distribution day. And what do you notice happen after enough D-Days accumulate? The market reverses, it drops higher. This isn't a coincidence. This is smart money, large institutions quietly sitting before the rest of the market catches on. When D-Days pile up, the market is telling you something. Listen to it. The most iconic distribution day example, the Nasdaq in 2000. The peak of the dot-com bubble. Look at this chart. Before the Nasdaq collapsed 78% from top to bottom. Can you count how many distribution days had already accumulated? Investors who knew how to read these days got out in time before the storm hit. Those who didn't, they held on, telling themselves the market will bounce back, and they lost 50 to 90% of their portfolios. I want you to remember this: the market doesn't care about your beliefs. It only cares about money flow on these days and how you read that flow objectively. That is exactly why I dedicated this entire video to market direction, because it can protect your capital during the biggest market declines. Now, let's look at a distribution day example on Vietnam index, the VNINDEX, from September 2023. After the market had rallied strongly off its November 2022 bottom, I've marked the D-days on the chart. You can see clearly, as the days accumulate, the market begins to weaken and eventually corrects. You don't need to monitor this with anxiety every whole session. Just spend a few minutes after each close to check, was today a D-day? That's all it takes. The second VN-index example, and this one I find particularly compelling because it appeared in late March and early April 2025, just before the market dropped sharply following US President Donald Trump's tariff announcement, which sent markets worldwide into turmoil. Look at this period, the days appear. The total count within 20 sessions crossed the 1 threshold, and right on cue, the market sold up hard. What's fascinating here is that if you were only reading the news at the time, before Trump's tariff announcement, everything seemed normal. Companies were reporting solid earnings, sentiment was okay, but the chart was telling a different story. Institutional money was retreating as if they had knew something was going to happen. Then, out of the overwhelm, the tariff news hit like a lightning bolt and the market crashed. This is why O'Neill says, don't trust the news, trust the chart. The chart reflects all information, including information you don't yet have. Now, let's move to the second tool, the follow-through day, or FTD. The FTD is O'Neill's invention for confirming that the market bottom has passed and a new uptrend has genuinely begun. The mechanics are straightforward, 3 stages. Day 1, after a market decline, you wait for a day where the index closes higher than the previous session. This is called day 1 of the rally attempt. This is not a buy signal, it's simply the starting point. Day 2 and 3, you monitor, nothing special required. The rally attempt remains valid as long as the index doesn't undercut the day 1 low. Days 4 through 7, this is the decisive window. If during this period the index surges at least 1.5% on higher volume than the prior day, that is your follow-through day. Note that I said volume. Without heavy volume, it's not a genuine FTD. Volume is what separates real institutional buying from a technical bounce. One note for those of us investing in less liquid markets such as the Vietnamese one, the FTD may occur anywhere from day 4 to day 10 of the rally, but the latter it occurs, the less reliable the signal tends to be. Let's look at a real chart, the Nasdaq in 2003, taken directly from O'Neill's book. After the prolonged decline from 2000, the dot-com bust, the market finally bottomed and a rally attempt began. On day 4 of the rally attempt, the Nasdaq surged powerfully on a spike in volume, and that was a signal for investors following O'Neill's system to begin buying again. Those who bought at that point and held the right stocks got one of the biggest bull markets of the entire 2000-2010 decade. This is the power of reading the right market signal at the right time. Another example from O'Neill's book, this time the S&P 500 in 1998. In the summer of 1998, the market suffered a sharp correction, the Russian financial crisis, and the collapse of the hedge fund LTCM. Panic selling were widespread. Looking at the chart, in early September 1998, a potential FTD appeared, but this one subsequently fell. However, in October, a clear FTD emerged on heavy volume. Following that signal, the market rallied powerfully and the S&P 500 went on to set new highs in early 1999. The lesson is, when fear is big, the FTD is how you recognize the storm has passed. No gut feeling, no guesswork, hard data, price and volume. Now, let's shift to Vietnamese market, the VNINDEX. Here's what I want you to understand. O'Neill's principles are not limited to the US market. Any market with sufficient liquidity on institutional participation, these principles work because they are based on the behavior of large money flows. This is the sharp decline when COVID-19 erupted in early 2020. Following the first rally attempt day on March 31st, 2020, a follow-through day appeared on day 4, and what followed was a 2-year mega rally, with many individual stocks gaining several 100%. The second VN-Index example shows something the market regularly does. It tests the FTD. After a follow-through day appears, the market often has a short pullback, a brief dip, to test whether the buying interest is real. If that pullback happens on declining volume, that's a positive sign. Supply is weak, selling pressure is fading. Conversely, if the pullback after the FTD comes on heavy volume, be careful, institutions may still be distributing. This third VN-Index example focuses on what happened in the aftermath of an FTD. Look at here. The FTD appears, and the market begins to rise. But here's what many investors overlook. An FTD is not a 100% guarantee that the market will climb in. After an FTD, you must monitor 3 things. 1. Is the market continuing to strengthen? 2. Are leading stocks breaking out successfully? 3. Is early distribution appearing after the FTD? If the FTD fails, meaning the index undercuts the low of the very first rally attempt day, you must exit immediately. No waiting, no hoping. Discipline is the only thing that protects your capital. In this example, multiple early distribution sessions appear after the FTD, causing it to fail, and the market dropped back below the original rally attempt low. After the May FTD failure, a new FTD formed in July, followed by distribution signals at the end of August and early September. I'll leave that session for you to analyze as a practical exercise. Identify the first rally attempt day, the FTD day, and the subsequent distribution sessions. We've now covered everything in the market direction framework. Let's revisit the core takeaways. Follow-through day. To summarize, the FTD confirms the market bottom is your signal to begin buying leading stocks. After the FTD, build position gradually, don't go all in at once. If the FTD fails, index undercuts the first rally attempt low, exit immediately, no delay. No FTD is 100% accurate, it is simply the best probability tool we have. To summarize distribution day, index down at 0.2% on higher volume. Institutions are distributing. 3 to 40 days signal a potential top. 5 or more days move to couch, no waiting. Stalling day, price rises slightly on abnormally heavy volume. Institutions quietly unloading. These days it expires after 25 sessions, combined with breaking leaders to confirm a top. I want to close with old news words you can see on trend. You do not need to know what market is going to do. All you need to do is what the market has actually done. This is the key. You don't need to predict the future. You need to read the present. The FTD and distribution day are exactly how you do that. Thank you for watching this video all the way through. If it was useful, please like, share, and subscribe so you don't miss the next lessons in the Stock Exchange series. See you next time.